Welcome to your Profitable Law Firm podcast. I'm Kelly Brubaker, your dedicated host, passionate about empowering law firm owners. Let's dive into the hidden strategies that lead to overflowing profits, scaled growth, and thriving lives. This is where overwhelm transforms into confidence, enabling you to create and enjoy your dream firm and your dream life.
Changing payroll providers is a critical decision that can have a significant impact on your law firm's financial health and operations. Today, let's talk about why you should switch, when you should switch, and why you should invest money to hire a professional to handle the switch for you. While the prospect of discussing payroll providers might not set your heart racing, it's essential for law firm owners. Here's what you should consider when switching payroll providers. So first off, let's evaluate your costs. Take a close look at your current payroll provider's fees. Are they competitive? Are there hidden charges? Consider exploring other providers to find cost-effective alternatives. Negotiate. If you're unhappy with your current provider's pricing, consider negotiating. Sometimes they might be willing to adjust their rates to retain your business. But remember hidden costs. Beyond the basic fees, consider the costs associated with errors, late filings, or inefficient processes. These can add up over time. Another consideration for switching is for improved services. So assess features. Does your current provider offer all the features you need? Look for services that align with your firm's requirements. For example, do they offer direct deposit? Ensure that your new provider supports direct deposit for employee payments. Do they have an online employee portal? Allow your employees 24/7 access to their pay stubs through a secure portal. If the portal provides self-service features to employees too, such as updating tax withholdings and retirement account contributions, it would be even better. Consider tax compliance. Verify that the new provider's service includes automatic electronic filing of all payroll-related returns. Some lower price providers only include the processing of each payroll and direct deposit to employees. Payroll returns may or may not be included. Reporting. Look for robust reporting capabilities to track payroll expenses and compliance. Know whether you will have an online dashboard that gives you a current status of your payroll responsibilities, or will you receive emailed alerts with a status update? Be aware where you need to monitor for your firm's compliance. And not to be left out, but user experience. A clunky interface can slow down your payroll processes, so seek user-friendly software that streamlines your tasks. Another consideration for changing is fewer errors. Fresh start transitioning to a new provider will allow you to start with a clean slate. Old errors will not carry over. And accuracy matters. Payroll errors can lead to legal issues, unhappy employees, and financial losses. Choose a provider that emphasizes accuracy. So when is the optimal time for transition? Choosing the right time to switch is crucial. Making the switch at the wrong time of the year creates a greater potential for errors that will come back and bite you in the future. So consider these optimal periods. By far, if you can make this happen, the best time to change payroll providers is at year end. Stop with the old provider by December 31st, and the new payroll provider starts on January 1. Why? Because it's a natural break. Year end aligns with all payroll filing deadlines. It's when you close your payroll for the 1 year and prepare for the new year. Transitioning at year end simplifies reconciling financial records. You can ensure accuracy in your financial statements. And from a tax reporting perspective, it's easier to handle the tax reporting when you switch at year end. So if you can't do it at year end, what's the next best solution? Similar to a year end, a quarter end provides a natural break because you have quarterly payroll returns that will need to be filed. It will minimize disruptions to your payroll processes. Transitioning at quarter end allows you to seamlessly generate quarterly reports for tax purposes. And then you can plan for the upcoming quarter with your new provider's features. So outside of those timeframes, the transition to a new provider will be very tedious and with a significant volume of data to transfer that many times needs to be transferred manually, which leads me to the next consideration, the expert advantage. While handling the transition internally may seem cost effective, hiring an expert pays off in the long run. An expert will help you navigate complexity. A transition to a new payroll system includes the migration of all data on an employee by employee basis. This includes data such as names, addresses, tax withholdings, deductions for elected benefits, pay rates, social security numbers, and more. Add to that detail wages paid and all withholdings per employee paid year to date. If you make the transition at a quarter end, most payroll services will only require this data by employee per quarter. If you make this transition at year end, gross wages, withholdings, and other deductions will not even need to be reported to the new payroll provider because all of those numbers always start January 1st at zero. But if you move your payroll provider during any other point of the year, the new payroll provider will require all data per paycheck in the current year to date by employee to be entered so that all payroll returns for the current year will be reported correctly. An expert will also help you navigate payroll legal intricacies. There's tax laws, labor regulations, and compliance requirements, and these vary by jurisdiction. A knowledgeable expert understands these nuances, and they ensure your payroll processes adhere to legal standards. Avoid costly mistakes by relying on someone who knows the rules. So, what are the consequences of mishandling this transition? You can avoid these pitfalls by ensuring a smooth transition. So, first up is financial impact. Incorrectly transferring payroll data can lead to delayed payments, and employees rely on timely salaries. Mistakes in tax filings result in penalties. These can be substantial, and in my 20 years of experience with this, the payroll providers never accept responsibility for these errors, and that puts the full financial impact on you. Mishandling payroll can lead to legal trouble. Protect your firm's reputation and finances. Also consider the reputation damage. Late payments or inaccuracies can demoralize your team. Inaccurate W-2s. Over and over, I have seen the following two scenarios with poorly managed payroll transitions. First is over-reported wages. This is when both payroll providers, the old and the new, file W-2s for your employees based on the information they have. This results in employees receiving two W-2s that, when added together on their Form 1040, will report more wages than they were actually paid. The consequences are additional tax will be owed, they may be pushed to a higher tax bracket, and possible deductions may be phased out at the higher income. All of this is wrong based on an incorrect, overstated income for the year. Or the second thing that I see happen is underreported wages. So, not to be left out is the possibility that if year-to-date wage information from the old provider is not reported to the new provider and the old provider does not file W-2s, employees will not have accurate W-2s reporting their correct full years of wages. This may create a situation where a lower than true wages creates tax credits on their Form 1040 that they're not eligible for. Those situations directly impact your employees. But what about the impact to the firm? So, inaccurate year-end payroll returns. Both of these situations create havoc and undue stress for the employees at tax time, as I just described. But don't think the firm escapes any issues. The payroll agencies you report to, meaning the IRS and state and local agencies, will take your quarterly returns filed by the firm during the year and compare the total of those quarterly returns to the annual return filed. For example, at the IRS, they will take the quarterly 941s, add up the gross wages for the 4 quarters, and compare that answer to the gross wages reported on both your Form W-3, which is the sum of all the W-2s issued for the year, and to your firm's 940. If there's any discrepancies, the firm will receive a notice of the error and instructions to correct the issue. This will take time to research and prepare amended returns, and I guarantee it will be frustrating to resolve. So, how do you make the transition seamless? As I already mentioned, expert assistance. Invest in expert guidance. They'll navigate the complexities to ensure compliance. And knowing that you're in capable hands allows you to focus on your core business. Another item to consider for a smooth transition is accuracy first. Ensure accurate data transfer. Double check employee details, tax information, and historical records. Test the new system thoroughly before going live. This transition as an opportunity. It's not just about switching software. It's about optimizing your firm's operations. A smooth transition sets the stage for growth. You can focus on serving clients and expanding your practice. Changing payroll providers isn't just about switching software. It's a critical decision that impacts your firm's financial health. Choosing the right timing, seek expert help, and prioritize accuracy. With these steps, you'll maximize benefits and minimize disruptions. If you have any questions about today's episode, please feel free to comment if you're watching on YouTube or send me an email to podcast@profitscalethrive.com. If you know someone who might need to hear this information, please share this episode with them. Or if you're on YouTube, you can tag them below. Be sure to follow and subscribe to get notifications for future episodes. Did you enjoy this episode? Please consider leaving a review. And before I go, remember, profit is something you intentionally plan for in the beginning. It is not a potential bonus at the end of the year. Thanks and have an amazing day.